Hello everyone and welcome to this special webinar event which is happening against the backdrop of the first reduction in interest rates in over 4 years. I'm Terry Ryder, founder of Hotspotting, and my very special guest today is one of Australia's best property analysts, Arjun Paliwal of InvestorKit. The background to today's discussion is that Australians endured 13 increases in interest rates from May 2022 to November 2023, and then 15 months with rates at very high levels. So now it seems we're starting an era with rates trending down. But while interest rates in isolation will not create another national property boom, they may boost markets that are sensitive to rates and may enhance overall housing demand. To explain what all that means, I'm joined today by Arjun Paliwal, who's the Director and Head of Research at multi-award-winning buyers agency InvestorKit. Arjun, always great to have these important discussions with you. How is 2025 shaping up for you and the team at InvestorKit?
Yeah, 2025 has been a great start to the year. And Terry, it's great to join you and everyone here at Hotspotting for today's webinar. In terms of 2025, I can definitely sense a huge sentiment shift. I think that's the best thing to call it. From our level, I think we've had the largest ever month of inquiries in our company history. For the month of January, we had over 550 people reach out for a consultation, which was numbers we haven't seen before. So yeah, it's been an active start. And I guess today I'd love to talk about some of the things you touched on around the interest rate world.
Yeah, I'm getting similar feedback from other people out there and who are real estate professionals and service providers that they have detected that sentiment split. Do you attribute that to the reduction in the cash rate recently?
I think it started even before the actual reduction, right? Because the reduction kicked off now in February. But before the reduction, I feel there was a sense of, hey, interest rates are at a peak. And I think that sentiment really started kicking off late last year, and the improvements were clear. And funnily enough, I think about when interest rates coming down, the borrowing capacity that changed over the last month only works out to be about 2.5% based on discussions with various finance professionals.
Sure.
But then we know 2.5%, say on a 800K purchase price is just over 16K. That doesn't unlock multiple properties for anyone. But funnily enough, it does show that how people's minds work and how sentiment plays a role in property investing. Because if that many inquiries came on in January with the thought it could make a difference, then it's clear that it's the thought that's powering things more than the actual difference of 2.5%, which is both a good and a bad thing. It shows there's many healthy family financial positions across Australia where they're able and now willing to make a move. But the bad thing is they could have made moves much earlier, because as both you and I know, there have been markets that, irrespective of interest rates, have performed well.
Yes, absolutely. Both in 2023 and 2024, we saw markets achieving boom level growth, both in some of the capital cities and some of the regional markets. Interest rates can be a factor, but it's certainly not the prime determinant of where people are going to find price growth as property investors.
Correct. I think that's a great starting point to talk about today. Well, whilst we're going to go through a fair few locations around what interest rates are likely to do in a couple of areas, at the same time, it's important to recognize that as investors, you need to be more micro-driven than macro, because the macro move is interest rates. But as we saw in 2023 and 24, almost all of Queensland, South Australia, and WA were by far the largest performers and grew multiple times against the national averages, whether it be cities like Townsville, Rockhampton, Cairns, Toowoomba, Brisbane in Queensland, Bundaberg, or whether you go out to WA in this Perth, Bunbury, Geraldton, and then over to SA, Barossa Valley, Adelaide, Mount Gambier. So these are just some locations where, irrespective of rates, they moved. And I think the biggest thing to look at is property isn't a game of isolated factors. It's a game of multiple factors coming together that have created a genuine imbalance in demand and supply in those cities. But where I want to start off with interest rates today, Terry, is talk about, okay, now we know in a macro environment, it doesn't make the differences that people think it does. Let's come one step down and say, well, what differences does it make when it starts coming through? And this is where I might share the screen to talk through a few key points from our latest research report.
Absolutely. Go right ahead.
All right. Well, this should now be showing here. And I know how you and I look like, so I'm going to bring this one a little bit smaller, and we'll bring that up there. Perfect. So I guess the 5 ways to start off with in terms of how interest rates will boost the market, because whilst it doesn't make the effect everywhere, it's important to know where it does make an effect, what are the things that improve? And the first thing is affordability. Now, we like to look at affordability a little bit different to how the mainstream media and economists look at it. And the mainstream media and economists often look at it from a perspective of multiples of income. And I think that measure is very much broken. People forget that we use leverage. People forget that income and cash isn't what buys the property in full. We take loans, we take different type of loans, finance availability changes, the repayments and the cost to us change, whereas the multiplier could keep increasing, but the actual repayment cost to us could keep decreasing, right? So this is why I think that measure is completely broken. Now, if we come down to a repayment basis, I want to highlight what's happened when it comes to some of the growth, firstly. Over the 2 years, when it came to 2022 to 2024, if I zoom into this chart, when we have a look at the highest growing areas over those 2 years as interest rates increased, it's clear that the money moved to the markets with the most affordability. And what we can see here is the highest levels of growth rates occurred in the most affordable areas. This is unique and quite the opposite to what many people think. Everyone seems to think in every cycle, the upper end moves the markets first and go blue chip, and all of a sudden the lower end follows. It's quite the opposite across Australia the last 2 years, and interest rates did have a part to play in it. So that's the first point to point out. Now, when we look at the alternate way of measuring household affordability, we like to use a measure where we take household income, we take an 80% loan to value ratio as an example, and we start looking at interest rates at 4.5%, the repayments against the household income, and also 6.5%, the repayments against the household income. And this measure creates a value or undervalue. And how that value or undervalue is created is we say, well, let's just assume 33% of income of a household goes to a repayment at any of these interest rates. And that 33% number, we're going to deem that number affordable. And then anything where the median price has to fall for it to actually reach that number at 4.5% interest rates means that it's slightly overvalued and the median house price has to come down by X%. So in this case, if we use the city of Bundaberg as a small example, at 6.5% interest rates, it would be 5% in terms of median house price, a little bit more than the typical affordable repayment. But as soon as interest rates come down to 4.5%, you're 19% undervalued. Now, like any measure, Terry, this measure in isolation is not a quick fix to growth spots or anything like that. But what this measure does is just one element of many things we review, which is showcasing an improvement in affordability for certain conditions, which means if there is a genuine undersupply in that market and the market is growing, then this just aids that for further legs because there is greater affordability in that area. Right. And it was clear that the most affordable markets 2 years ago when we released this report, this first report here specifically on overvalue, undervalue, the most undervalued markets were the likes of Perth, Bunbury, Geraldton, Townsville, Cairns, Rockhampton, Bundaberg, back when interest rates were calculated at that level. So it just shows that it can help in that mix. But that's the first thing there, Terry, which is it will improve mortgage affordability. Any questions on that one before I jump into point number 2?
No, beautifully articulated and totally on board so far.
Awesome. So number 2 is home buyers coming back to the market. And I think the key here is that there are many people where they do drive off sentiment fumes to make decisions. And the home buyer market is definitely one of those. And when it comes to some of the lending indicators, we see that the home buying market here was more suppressed when it came to some of the interest rates increasing. And so investors did uplift during that time, but the home buyer activity fell down a little bit. So for example, homeowners lending activity significantly slowed as interest rates started increasing, and then they began declining in 2023. And then first home buyers, whilst an elevated number, started declining as well in 2022 after interest rates started increasing. Now, this isn't a a pricing analysis. This is just a finance analysis, which shows that, finance trends wise, that they did slow a little. So you'd believe that the opposite would happen when interest rates improve for these two buyer segments. Now, when we look at it, here's an example of some of those loan commitments. So you can see as interest rates started to come up, first home buyer loans came off, owner occupier loans came off, but investor loans still continue to move quite strongly during that time period. Now, when it comes to the third point, lower rental yield requirements. So this is an interesting one we've already noticed in some of our clients. So for example, pre-interest rates coming back down, someone used to say, well, I'd really like the rental yield to be over 5%, as an example. Whereas now, as interest rates are looking to come down, the buyer's mind is slightly changing. Hey, I don't mind taking a look at 4% plus yield locations because I believe that X will happen. And the X is that interest rates continue to come down from where they are. So buyer appetite is likely to change as to what they deem as a good or bad rental yield across Australia, which means some of those markets and higher price points will start having a little bit more love just because the appetite is starting to shift.
Okay.
Here's a bit of a showcase of those markets across the country with different yield ranges. So this was really the focus for many investors across the last 2 years to nullify some of those costs. We should start to see them be more open to many different yield locations as interest rates continue their trend down.
Does show you just how rare and precious those locations with the 5% plus rental yields are.
Absolutely, that is the case. But funny enough as well, these locations happen to boom the best over the last 2 years. So it shows that, even in some of the locations that we think are going to have high growth, low yield, it's not the equation. That's not how it works. It doesn't just equal high growth because there's low yield. And that was the case for the last 2 years.
Arjun, with the graph I'm looking at there and what you've been telling us up to this point, are we talking about house markets or are you also including unit markets?
Yeah, good question. This particular analysis has been all focused in on houses. It's not to say units will, not have some growth in a few key areas. They already are showing those core signs in some areas. But this is a house analysis for today.
Okay, fine.
Now, this next part is probably the thing that I've been calling out for some time, which I think is probably one of the bigger drivers across Australia. And what I feel is really not to do with interest rates, but more to do with the outcome of those interest rates over the last few years. So if we have a look at the interest rates and the impacts over the last couple of years, we've seen lower quartile markets really outperform in terms of some growth rates. And what we can see is some high growth happening in a lot of lower quartile markets. Now, when it comes to the lower quartile markets, that creates a unique environment where we see someone maybe looking at an outer ring and going, hold on a minute, if I cashed out here, I might be able to move closer in and it's not that much more. And to give you one example of a market it's really evident in, it's actually evident in Perth. Perth's inner ring, statistical area 3 locations have actually had about 30% less growth in Perth's outer ring over the last 2 years. So it's likely that there may be a swing that occurs off the back of either A, upsizing activity, or B, just value-based activity where people think, well, I could be a lot closer in. Now my mortgages allow me to be closer in, and I'm willing and able to look at markets that are a little bit more expensive than I once was. And so there's also that good old return to certain averages. And I have a good joke about it and say, whilst Penrith did outperform Bondi for a couple of years, can Penrith be as expensive as Bondi? And that's the thing where most people will say probably not. And so I think there's an element of, the more premium markets across Australia as rates come down, that there will be a bit of love go back to them, both from sentiment because of those people that could always act on it, but then secondly, mortgage affordability allowing a little bit more. And we're starting to see those trends emerge in a few inner ring markets where their price growth is picking back up.
Okay.
And the last one here is consumer confidence. So Terry, the key thing is we talked about the sentiment improvements. We've realized that that's coming in play. And you can see that it wasn't just interest rates coming down that helped it, but it started increasing with the thought that interest rates may come down. So late last year, we started to see some sentiment improvements, and we're seeing it come off the bottom. Now, it's still, a fair bit below long-term averages of various consumer sentiment surveys, but a recovery cannot be ignored. We're noticing it in our contact base from clients reaching out. We are the largest producer of research amongst buyers agents in Australia when it comes to the research reports put out there from our white papers and frequency of blog posts. And when we do that amongst the buyers agents, we're noticing a lot of activity happen in our research. So it's clear that sentiment, the desire to learn more about the markets and what's happening today is increasing. And it's also evident here with some of the consumer sentiment surveys. So I think, when you're looking at the sentiment improving and you're looking at some of the other points of the outer ring demand potentially flowing through to some high middle and inner rings, as well as owner occupiers looking to return back and investors being more encouraged with lower yields and feeling comfortable about it, as well as some locations being a little bit more affordable, you've got some improvements that will happen. But again, like me and you started on this call, you can't blanket approach that everywhere. You need to look at locations that will have that sensitivity, but you also need to understand that there are some locations, irrespective of this change, are going to keep on keeping on. And that's the key thing. So Terry, before I move into a few locations, would you any questions here that you'd like to go over these 5 core points, or any things that you've spotted of interest?
John, just one question. It may be slightly off topic, but we're talking about sentiment and the positive impact that it appears that an interest rate reduction has had on sentiment. We're clearly in an election cycle, a federal election cycle, although they haven't officially called it yet, but it'll be happening soon. Is there going to be a counterbalancing break in terms of sentiment, given that some people at least put decisions on pause while there's an election happening?
Yeah, you're right. It still baffles me why so many people do that. I mean, there's data that goes far and far wide where it doesn't showcase a magical property period or an affluent property period under a certain type of leadership in Australia. It just isn't the case. And the key is that I wouldn't be doing that because, as you and I both know, there are so many markets across the country that will be different, and what they need to do for your portfolio is all up to where you are today and where you can purchase next. So I think those who are waiting on that, and funnily enough, yes, you will see some sentiment shifts on that curve simply because of that. It's a silly thing to do.
Sure. Just before you resume your presentation, Arjun, I just want to remind everybody out there watching and listening that we will field your questions towards the end of the webinar today. So if you do have any questions, please type them into the Q&A panel that you should see in front of you, or the chat box. Either is okay, and we'll try to answer as many of your questions as we can before the end of the hour today.
Absolutely. Awesome. So Terry, I might do the big spoiler now instead of giving away one market each at a time. Here are the markets across Australia which demonstrate traditionally in history a higher sensitivity to some of the cash rates, right? Now, it does not mean that these are the only cities that will turn around. These are not the cities' full fundamental reviews. These are the cities' isolated reviews to sensitivity for interest rates. So what we've looked at is many previous interest rate cycles. We've looked at mortgage affordability in each of these cities. We've looked at transaction volumes changing in recent times as sentiments improved, as well as how transaction volumes really got hurt when interest rates did increase. And the thought here is that these are markets that will, either A, find a floor under their sort of softening patterns, or they'll start to see some rise up, but it does not equal boom time, right? Boom times do not simply happen just because interest rates are coming down. This research report is all about which cities have sensitivity to it and are likely to benefit from that sensitivity going the other way. And so what you can see is a fair few high-priced markets like Sydney, Melbourne, Coffs Harbour, and then Sunshine Coast. And you've got some other markets more in the middle pricing areas like Newcastle, Geelong, Warrnambool, and then you've got more affordable areas like Bendigo, Albury, Wodonga, and Wagga. So these are some markets where I'd say over the country, they're going to have improved outcomes from that sensitivity being in their favor as more and more rate cuts kick in. But each city's fundamentals are going to be the decider to whether there's a actual boom or not, but they will have a floor under them, or they will start improving as a result of these changes. So that's just tied to interest rates only. That's the key thing to recognize. Now, I might jump into a couple of areas just to showcase a few things to look into. And what we'll do is we'll jump into a hot topic area right now with everyone, which is Melbourne. And what we can see is a few trends here in Melbourne. So the first thing is we can see recovering sales volumes in activity in Melbourne. And I apologize for those on with regards to the recency of data. That is quite recent on our back end, but this report we produced late last year. So we didn't get a chance to bring to the light late last year, this report. So I wanted to do that today. And thank you, Terry, again, and the Hotspotting team for giving us that opportunity. So in terms of some of the core things in Melbourne to notice, though, is that we are seeing sales volumes recover. Again, not from interest rates. They were recovering since February last year. So that's one thing.
And evident in the data we've just looked at for the December quarter, that it's definitely a continuation of the trend that you're showing in your graph on screen in the intervening time since that graph was produced and now.
Absolutely. And Terry, right now, because interest rates haven't kicked in terms of the frequency that people are seeking or expect to happen over the next year or two, it's also important to recognize that CoreLogic is probably one of the worst places you can look at for a whole city analysis of Melbourne. And the reason why is if you're looking at a whole city analysis, you're going to miss out many of the micro trends occurring in a 5 million plus population city. Right now, to give you some context from on the ground activity, there's reports of over 50 plus people attending open homes and inspections in the sub 750K market. But as soon as you start touching the $900 million plus market, it's not to say they're not active, but you're about a fifth of the volume of activity. And so that clearly shows that median prices to track a whole city is not going to be as clean and not going to be something you should rely on to say, oh no, the city's not doing anything. Well, you're not isolating it to the key pockets where you might buy. And so that's a key trend.
Arjun, I think it's one of the most important learnings that people can take away from today, that the generalization in some of those data houses and in media generally really doesn't serve consumers terribly well. It's similar, I think, with Sydney, where the generalized figure shows very, very moderate growth in 2024. But when you look behind those figures, individual markets within that very large city have done, well, 10% or better in some cases.
Absolutely. Absolutely. Great pickup. And the key thing is, whilst there's a recovery starting to emerge, you haven't missed out of anything just yet, in my humble opinion, with the city of Melbourne. And the reason why we've got days on market, which has trended from a elevating to a flattening cycle. And we've got vendor discounting just starting to come down. And we've also got inventory at a balanced level. So it's not extremely undersupplied just yet. Price growth wise, it's also flattening in some areas, with some areas starting to increase. So I don't think you're by any means too late to the city or too late to the recovery. And I think further and further interest rate cuts will aid the city. And we hope to see that heat in the lower rings start to expand to middle and upper rings as time goes on. And I think auction data is a good one to follow in cities like Sydney and Melbourne, only because they're not clean data in other cities, but those two cities do have a good proportion of stock follow that activity, and auction clearance rates are starting to recover as well in the likes of Melbourne, which is a good sign. Furthermore, if we're looking at Melbourne's affordability impacts right now, again, this measure can't be relied on isolation, but at 6.5 interest rates for the typical investor, you get what's called a 25% overvalue in Melbourne. But as soon as you start getting to 4.5% interest rates, you're near fair value. Now, this is a whole city again, whole city's median, so you can't look at it in isolation. But any time that the overvalue, improves, that's a good sign for an area. Another thing to see here is we look at market cycle growth by like different intervals. And what we can see is on a 7-year average for Melbourne, it's only averaged 3.9% per annum, well below its long-term averages of near 6%. So from a cycle position, it's also well placed in terms of you're coming in at a time where you haven't missed out much, like the rest of the country has seen some static booms. And then when it comes to rental yields, this is probably the favorite part for investors. Huge jumps from just a couple of years ago, where you'd be getting typical house yields at 2.8%. Now they're upwards of 3.5%. Now, is that sexy in comparison to some of the smaller markets across Australia? No, it isn't. But for those who know Melbourne for its history, Melbourne's history has always been known as a low yield market. And now that low yield market is not so low anymore. And as interest rates keep coming down, that yield starts looking better and better. And because prices are flat at a city level, as rents keep increasing, you'll see that yield improve again. So I think it's cases like those rental changes, which people sometimes fear, right? With more people selling out. But with all that sellout that's occurring, we are seeing rental pressure pick up in the recent years. Whereas across the country, whilst vacancy rates are still low, rental pressure has eased off in other parts of the country, but rental pressure in many parts of Melbourne has actually increased a fair bit. So I do think that's a result of that sort of self-inflicting policies and things like that have been placed in. But you also got to look at Melbourne carefully because there are some regions where vacancy rates are elevated, and that's an example of markets within a market when you're looking at a city of that size. So that's an example of like some of the cities here. And if anyone wants to grab a full copy of this report, they can visit investorkit.com.au and click on our property research tab. It's totally for free. We produce a new report each month, and the next report coming out end of Feb in a few days is going to be the Undervalue Overvalue 2025 edition, which will factor in market improvements in areas when interest rates become even lower. But in summary, Terry, these are just cities where the sensitivity will improve, but it doesn't mean that their fundamentals are rock solid. It's just interest rate sensitivity will improve there more than elsewhere.
Sure.
That's it from me today, and I'm more than happy to jump into any questions that may have come through.
Okay. Actually, just before we leave the topic of Melbourne, because we're getting a lot of inquiry. You're obviously feeling it too, that more and more people are showing interest in Melbourne. I think one of the reasons is the comparative pricing, because other cities have grown so much in the last couple of years, and Melbourne hasn't had that growth. The relative affordability of Melbourne in the eyes of people on the outside looking in, obviously much cheaper than Sydney. In terms of median prices, lower than Brisbane, starting to be almost on a par with the Adelaides and the Perths. It does tend to suggest that Melbourne represents pretty good value.
Yeah, it's a great point. Value is definitely important. Whilst you and I love the numbers, we love our stats, we love the data, seeing what patterns are emerging. Sometimes there's just let's take a step away from the data and think of that, human emotion. And I look at my team as one good example. We've had about half a dozen people move over to Melbourne, and you just ask, you remain curious, and you say why, and then they go, well, it's just a bit cheaper there. And so Sydney money can clearly do a lot more in Melbourne than it can in Sydney. And whether that's migration patterns that are improving, or whether it's rental affordability there being cheaper rents in some parts of that city versus here in Sydney, it's just an example of putting data aside and realizing that humans want to go to somewhere where they feel they can have a great place to live in, and also not at a very costly price to what they feel is costly. And that city's emerging in that field for sure.
Right. Okay. I was just interested in that list of locations that you particularly highlighted in your report. And you spoke in detail about Melbourne, but others there were markets like Warrnambool, I think, Bendigo, Albury, Wodonga, markets that I know had a wonderful growth spurt, say from 2020 to 2022, and have kind of been on pause. What you and I might both call second wind markets, perhaps, poised for another. Do you see it that way?
Yeah, so I do see a bit of a recovery in there. I think right now, to give you an example, Warrnambool sales volume started recovering sort of June last year. Housing inventory peaked at about June last year and it's been coming back down. Vendor discounting peaked at about January last year and has been improving, but days on market is still elevated and increasing a little bit in Warrnambool. What I just think is that I don't imagine all of these cities will go into this new boom. I just think some of those cities with a good undersupply of housing and these sensitivity things improve will strengthen quite quickly. But then other cities will probably just find a floor, right? So I think Warrnambool is one of those markets will find a floor. The bad times will probably be behind it, and it'll start to return to a little bit more normal growth rates. And it did have a bit of a slowdown, but I think it's got a great lifestyle area. It's become very popular in previous years as well. Lots of new jobs in the renewable energy space that have come into the market. And it's not as far as many people think. and it's a really pretty area too. So I think I can't imagine it being a long-term poor performer, especially since over the 25-year average, it's done just as well as the likes of our major cities. It's just a matter of that sensitivity was there as soon as interest rates came up. That city did feel it, and I do feel that just like it did feel it on the way up, it should recover some percentage points on the way down.
I'm interested to know how you kind of isolate the various impacts that might cause demand to fall away in a location like Warrnambool. How do you identify that it's rising interest rates that cause that? Because there's so many other factors in markets as well.
Yeah, it's a really good question. So with these selective markets, some of them were like a multitude of factors and we couldn't isolate it as cleanly, but interest rates happen to be the biggest macro variable that changed. But then there are some markets where we go, okay, sales volumes weren't falling off pre-interest rates coming off. Vendor discounting wasn't falling off. Job markets are still tight. Like it just felt like we're scratching our heads and going, what changed other than that? So
Sure.
I think those markets highlighted in this report a little bit more, but there are some markets where, like I pointed out with Melbourne, that that's been weak for 7 years. Like interest rates did not make that happen. So I think from 7 years of that weakness, that was clearly well before interest rates went up. Interest rates are coming down since a 2012 all the way to 2020, and that boom of that city ended in 2017 before it had a weaker period during the years to follow, even as interest rates continue to get cut. So I think that particular city was a multitude of factors, but then some others are seeing just when that happened, they just happened.
Sure. Just a reminder for everybody watching and listening today, please give us your questions. We have an opportunity for the next 20 or 30 minutes to throw your questions, anything to do with real estate, anything to do with location, the topic of today's discussion. Don't waste this opportunity to put your most burning questions to Arjun Paliwal or myself. Michael is asking for our view or your view, Ocean, on the high yield markets such as Darwin and how they might be impacted by the interest rate reduction.
Yeah, it's a great question. So with regards to Darwin, it is showing a lot of interesting signs there. I think the main thing is I wouldn't put that to interest rates because interest rates didn't make a huge shift in a positive way for that economy. That economy has been really seeing a huge amount of projects come in. And currently, it's actually ranked number one in Australia for infrastructure spend per capita. So as a result of that, I don't think interest rates coming down is going to make any impact there. It's already quite strong in that recovery for infrastructure spend. And you can see all statistics from job advertisements improving, the local economic diversity with a few other things, not just the gas, there's some other space in the renewables as well. I think the main thing here is that and defense. And I think the main thing here is that that economy is starting to revive again with some of the pipeline of work. And I think that will be what brings it back around. Also, I do think in that city, like you're seeing a lot of recovery in trends, like sales volumes are picking back up, vacancy rates remain pretty low, rents are rising in some pockets. I think the careful thing though is don't just assume because it's had a weak 10 years, suddenly it has another good 10 years. What many people don't realize is that the 10 years prior to the last 10, Darwin actually outperformed everyone.
Sure.
So if that was the case, you could almost argue that the last 10 years of slow markets were just bringing Darwin back to normal averages because Darwin's 20-year average is the exact same as Sydney. And so if it's the exact same as Sydney, people just have short-term memory thinking of the last 10 years of Sydney and then the last 10 years of Darwin not being so good. So what I'd say is that don't think of interest rates and that impact for Darwin. I'd say if Darwin's recovery is coming up, it's coming up solely because of its local economy starting to shift and improve again.
Look, I totally agree with your sentiments about Darwin. We actually expected to do much better this year. I'm really interested in your comment that it's number one in Australia for infrastructure spend per capita, because I recently did an analysis for Hotspotting and came up with the same conclusion. It actually by quite some margin. Keeping in mind, of course, that Darwin is population-wise a very small city, but relative to its size, its infrastructure spend is big, and there's a lot more to come. Some huge projects targeted on the Northern Territory. They're probably not all going to happen, but we only need maybe just one or two of those big projects to happen. It's really going to supercharge that Darwin market.
Yeah, definitely. It's got a lot going for it on the economic side. And I just think some of the macro numbers when they're that strong for a city of that small size, you can have some pretty big bumps when they do pick off. And The same thing happened with Townsville, right? You saw unemployment rates come down from over 10% down to under 3%. We saw the city deal from a federal level come in and make a huge diverse impact of on the economy. And we saw job ads recover. We saw housing supply dwindle. So some of those same signals are showing there, but obviously it's got some diversity things that you have to be mindful of with your portfolio and what you think of. I would say for a seasoned investor who's got a good diversity amount in their portfolio and they're looking for a market which offers a bit of you know, different cycle stages to what the rest of the country's seen. While you've got booming job ads, you've got, you know, ranked number one in the country for infrastructure spend per capita. You've got a high level of mortgage affordability, strong household income, unemployment rates are below 4%. And like you said, you've got a lot of activity there as well. With sales volume actually started rising in about August last year. So August last year, the activity started picking up, and days on market has been reducing since May last year.
Yeah.
So yeah, it's got some signs that are starting to improve.
Yeah, definitely concur with all of that. I think that's one of the ones that may surprise people this year, and we're certainly getting more people asking us about Darwin, attracted by the fact that they have the highest rental yields in capital city Australia. And Dish is asking, is it too late to buy in regional Queensland?
Yeah, good question. I think this is a really, really big mistake many people make. They think that just because an area has grown a lot, it must be over. I can vividly remember many commentators on our social groups and social communities going to 2018 and saying 2017 and going, Hobart's done. A couple of years like that, no way. 2018, Hobart must be gone. 2019, surely this is the end of Hobart. 2020, 21, like the broken clock's also right, a couple of times in its cycle. I think the main thing there is that people believe that markets only boom well for a couple of years. Yes, the majority of averages show 2 to 4 years seems to be the sweet spot, but we've seen booms extend up to 6, 7 years in some areas. My key thinking is this: markets are self-regulating, meaning if someone doesn't feel value in it, sales volumes will come off. If people want to cash out, listings will come up. If people don't want to live there, rental vacancies will increase. If people, can't meet the buyer market or the seller market and they're too impatient with each other and they're not getting there, days on market will increase. So it's always self-regulating. It's not this thing that just because it's grown, it stops. If it hasn't stopped, it hasn't stopped. And so my key thinking there is that regional Queensland has a lot to catch up on, even though it's had a great couple of years. Many people forget that between 2011 and 2021, there was little to no growth in most of regional Queensland. So I think that recovery still has more time to bring its averages back. Obviously, there's a couple of cities in regional Queensland that have done a really, really good amount, like Sunshine Coast did between sort of 2015, 16, all the way to 2021 before it calmed down. So there's just different markets within markets. I would say places like Townsville, Rockhampton, and Bundaberg still have some legs left in it. Same with Cairns. And then you see markets like Toowoomba, which keeps surprising me every year. Like it's done so well, but continues to be quite tightly held. And then I think interest rates will positively impact places like Sunshine Coast, but they haven't done as well in a couple of recent years in comparison to, say, some of the other markets in the more affordable price points. So look, it just depends where in regional Queensland, but it's not too late because the trends, the economy, they're still quite strong. But as soon as you see all those trends fall off and they're not looking so good, then there's your answer. So yeah.
And I would point out again the point that we made earlier that regional Queensland is a very big place. It's a very large state, and it's not one market. There are markets in regional Queensland that are a little bit earlier in the cycle than some others. And just also had a question earlier. It may be a little bit beyond our pay grade to answer this one. Is saying people say that setting up a discretionary trust helps them increase your borrowing power. Is that true? I wouldn't feel confident to answer that. How do you feel, Arjun?
Well, it's good timing, Terry. We've just actually acquired a finance firm as part of our greater group. And so I've been blown away, and I've got to share a really, really important point here on this. We did an exercise looking at our top 100 clients. And our top 100 clients, we noticed, okay, what's the common trail here, right? Like, of course, we've helped them with strategy and research, but property is a game of finance is the same. And what we realized amongst our top 100 clients was there was one commonality, and that was a finance broker. And this finance broker was doing some magic. And I felt that that was the difference when I looked at it, and we engaged in conversations and we've partnered since. That company's called Foraker Financial, Fouracre. financial.com.au. And the reason why I share that is that they've helped many of our team members and clients using strategies to get lending and grow the capacity. And trust lending does fall under that because it's not just about which bank you go to, it's also which structure that you apply. But there are things that are very unique to each person's individual circumstances. So you can't just say and set up a trust and say game over. That's how you now get your next place. It's not that simple. But you need to know, the LVRs, the cash flow situation, your personal situation, which bank you can and can't go to because of your personal situation. So my answer there would be reach out to fouracrefinancial.com.au. And Jack in the team there is brilliant at what he does. He's a co-host with me on the Property Nerds podcast, and we've partnered in recent times. And I'm very grateful for his partnership because he's been the commonality across our top 100 clients. About 30% of our top 100 clients use that team. So you're in good hands if you check them out.
Look, I would endorse that. I think it's so important for people to consider structure before they go out and commit to buying a piece of real estate. I'm always amazed to talk to quite seasoned investors who've never even considered it. I did a session recently with people who owned 3 or 4 investment properties about to buy another, but had never considered whether it was best to buy in his name or her name or joint names or in a trust. And there's so many pros and cons that need to be considered, and important for people to actually spend a little bit of time and maybe a little bit of money on getting expert advice on that before you start buying large chunks of real estate.
Yeah, spot on.
Andy is asking a broad question, but a pertinent one. What factors do you consider to identify a hotspot, and in what order?
Great. So I won't be able to jump on all of the things here or the order, but I'll give you a couple of key points. I'll try and break it down to 3 really simple points. The first is the local economy. Now, with the local economy, like that brings back a lot of competition in markets through improved confidence, whether it's infrastructure spend and infrastructure spend per capita, job advertisements and unemployment rates, local affordability within that economy. And those are some of the core factors. But also there's the infrastructure type. It's not just what's being done, or how much being done, it's also what's being done and when it's being done. So all of these things are a great booster to an economy. And for multiple reasons. For the locals there's more jobs being created. For the locals there's more migration because of the more jobs. For the locals there's more confidence. And then for those non-local, there's more desire to invest in areas that show some of these signs as well. And that's the same thing for the locals. So that's one key thing here. You can't just expect a city with nothing going on to suddenly move mountains. There has to be some sort of deeper economic, impact there for it to be a long-standing trend. The second thing is we bucket in terms of something called market pressure. And market pressure, we like to say, is just the imbalance of demand and supply. Whether you're looking at inventory levels, sales volumes, listing levels, days on market, auction clearance rates, vacancy rates, vendor discounting. The key here is you're looking at the availability of housing versus the demand against that availability of housing. And that itself being strong is a sure thing for growth to occur, because I'm yet to visit a housing market where people took longer to sell, had less deals occur, had lots of properties available for sale and lots of properties available for rent and lots of properties in construction and very weak auction clearance rates that grew in prices. There's never been one in history. And then the third and final point is success leaves clues, meaning if a market has increased over the last quarter, 6 months, 9 months, 12 months, it doesn't just disappear. Housing is a very slow moving transaction game. Data is often lagged by 1 to 3 months. You also see transactions take 30 to 60 days to settle. You also see a lot of activity, then you make a decision and there's hundreds of sales before making that decision. So what I'm saying there is that if a market's moving, it's moving. And so you don't have to always be there just before it happens. Sometimes the highest confidence and the highest growth rates come through when it is happening. And so that, in my definition, is a hotspot, something that is happening. Therefore, you're not missing out on anything because it's happening as you see it.
Andy, I think that's the best answer you will ever get to the question you've just asked. How do you identify a hotspot? And I note, Arjun, that you spend most of the time in your answer talking about local economic factors. We feel exactly the same way at Hotspotting. It's so important to understand that markets are local in nature and they arise out of local economies. If you get one of our location reports, it might be 20 pages long and only about 20% of it we dedicated to talking about what's happening with prices and rents and yields. It's all about talking about the local economy, about infrastructure spend and demographic factors, all of those things that underpin a really strong property market. Dean is asking a question that I get asked every single day, and you probably do as well, Arjun. Where do you see the hottest new market to perform best for houses? How
Yeah,
would
it's
you
a
answer
tough
that
one.
question?
I mean, look, I wouldn't say new market because usually the hottest performing markets are the ones that are performing, and they tend to just spill over into the new year. And the highest performing ones seem to be across in Queensland, based in Townsville, Rockhampton. In WA, I'd say Geraldton, Albany, and Perth seem to be really up there, and even Bunbury. And then in SA, Mount Gambier, Barossa Valley, and the northern and southern suburbs of Adelaide. So I'd say like wherever is very hot now doesn't just fizzle off overnight. And so I think some of those markets I've mentioned seem to be like displaying numbers based on their month by month growth rates and month by month activity. That 2025 should be another bumper year for them. And then as the rates continue to come down and people start feeling a little bit more open to going back to those other markets or markets where they've been a bit more affordable, like Melbourne, naturally then Melbourne and some other pockets will step up in the recovery game. But if your answer is just the hottest market for the hottest growth right now, then it's some of the ones that I've mentioned in terms of the right now growth. You could even extend that list to Gladstone as well in regional Queensland. But I'd say it's a lot of those regional markets in Queensland, WA, and South Australia.
Yeah. And if the essence of your question, Dean, is where's the best place to buy right now in Australia, there is no best place. It very much
Correct.
depends on your circumstances, how old you are, how much you earn, what you already own. So many different factors. There might be a different answer to that question. If you six people ask that question, there might be six different answers. Keep that in mind. You touched in your answer, Arjun, on Adelaide, and earlier you mentioned that sometimes markets don't just have 2 or 3 years of growth, but they keep on growing. Every time I look at a graph for a suburb of Adelaide with price growth for the last 5 years, it's just this steady upward path and no sign of slowing down right now. So I think it's a great example of what you said earlier, that some markets, if the fundamentals are right, and I think it's certainly true of Adelaide, they do keep on keeping on.
Absolutely. And anyone who wishes to challenge that, just look at Adelaide in 2019 when the trends first started emerging. That was not a post-COVID sugar rush. That market's been improving just pre-COVID. So I would say that that local economy, all the signs were quite clear from 2018 onwards. So yeah, that city's now going on to 6 to 7 years of strong performance.
Yeah.
I think one more thing to add in there when you said around, hey, it depends on which market's best for your portfolio. There's a question here by Kelly. Kelly talks about Bendigo. And
Yeah.
I reckon that's a great question to raise because there are some people who I've seen Bendigo is best fit for their portfolio. And this is understanding someone's portfolio more than it is the actual markets. Because, for example, in this case, there's a client who's come to us and said, I'm a very good saver. I earn a good amount of money in terms of my ability to get deposits and borrowing capacity for multiple areas. And I don't need this first investment property to run away immediately for me to get the second. So for that person, you can actually work against the grain and buy in some markets that are very hot, and then buy in other markets that are actually seeing a dip, which gives you an opportunity to buy as a second wind market before the next wind arrives, right? And so that was an example where for their portfolio, a combination of a regional Queensland asset and a combination of Bendigo made a lot of sense because we've got that regional Queensland asset that's growing strongly, higher yield, more affordable. And then we've got the market of Victoria and Bendigo as an example where someone's like, oh, I'm not so sure about Victoria or the laws here or the price growth here, but they've bought themselves a property for a much better price than what they typically will be able to do so in the years ahead. And they've also been able to secure a great rental yield because of the strong price negotiation in a market that typically doesn't offer very high rental yields. And so this
Yeah.
is an example of that individual situation coming up most. If it was a first-time investor, a lower income earner, a lower savings capacity, and unable to jump to the next, then no, a market going through an early recovery stage might not be the best part. Somewhere hot, somewhere growing fast might be best for them. But they have to face the music with competition and they have to be quick and aggressive and get into the right markets. But then someone else like that client there, she was able to go through two, hedge them quite nicely. And she's got one asset growing where she can revalue in the next 6 to 12 months confidently. And then she's got one asset there that before the party starts, she's planted herself well and she's negotiated so well ahead of time that she feels comfortable holding an affordable asset in a major regional center like Bendigo. So I think that's a perfect question, both Kelly, in terms of what we think is going to happen, but also at the same time, like it's about diversity in a portfolio and what you need, not just which market's best for you. And that's two different investors, two different outcomes.
Okay. Jeffrey is asking about Moreton Bay, and I assume, Jeffrey, you mean the Moreton Bay region, the local government area that's encompasses the northern suburbs, the outer ring northern suburbs of the Greater Brisbane area. You're pointing out that it's performed very well in recent years. And what is your view, Arjun, over the next 2 years there?
Yeah, look, I have to admit, I haven't had a huge amount of preparation today with Moreton Bay in specifics. So I don't have some of the data here today to comment on that. But what I can say is that knowing that area quite well, housing markets are still quite tight over there. So I don't expect a sudden weakening or a fall off. But what I would say is right now, something interesting that's come up in Brisbane or in Queensland has been some of the activity for first home buyers. So last year we've seen first home buyer stamp duty exemption go up to 700K, I believe, for established homes. And then now it's trending up to, I believe, no limits is soon to come for new builds and new homes. And so I think stuff like that is always positive for a few markets, especially in the more affordable parts of Brisbane, like the north side and Moreton Bay, or the south side or even west side in the Ipswich Council. But what I would say is I don't have a firm enough read on Moreton Bay right now just to give a rock solid answer on that.
Yeah. Look, Moreton Bay has been a great performer. It's attracted buyers for its affordability. Some of that has been lost because there has been substantial price growth in that market. So not doesn't quite have that affordability attraction that it did, but nevertheless, very strong market. Different elements. So it's a very big local government area. All the local government areas of Brisbane are large, and Moreton Bay is one of the largest. Includes different elements. One part of it is the Redcliffe Peninsula, which is one that we rate quite highly. It's been gentrified over a period of maybe the last 10 years, but still presents good value for money in a peninsular environment with now train links to the centre of Brisbane, which is something that didn't exist until about 5 years ago. And also some good value in the apartment markets there. In other parts of Moreton Bay, I would suggest that if you're going to be buying in suburbs there, think about the location of the university campus. It's only been established in the last few years. It's a work in progress. It continues to grow, but it's having a big impact on nearby suburbs like Petrie, Launton and Kalanga.
Well, in recent times there, Terry, I've just pulled up some data on our side. We've seen some good activity in the Moreton Bay precinct. So I'm just going to give it a very simplified review. But Strathpine SA3 region's up 15.6%, North Lakes 13.3%. Then you've also got Caboolture up 14.3%. So there's been like about 2/3 of the Moreton Bay region has had double-digit price growth over the last 12 months. And when we're looking at the Moreton Bay region as well, like we've seen some yields for most of those are still hovering around the 4% plus yields, which is pretty healthy in capital city markets.
Indeed. Deer's asking for our thoughts on the Whitsunday region, Ely Beach, and the Whitsunday region generally as a growth possibility. Do you have any thoughts on that one? We recently updated our report on the Whitsundays, and we do see prospects there.
Yeah, look, I think we see above average growth happening there based on some of our reads. So I don't see some 20%, 30% plus market over there, but I do see, above long-term averages still placed there. I mean, it's not by any means oversupplied or any metrics like that showcase weakness. It's not extremely overpriced either based on some of the lifestyle aspects that you get there. So yeah, we do see some activity occurring and recovering, but not too deep of a read there just yet.
Yeah. Look, I've been a little bit reticent about the Whitsundays region because I felt that it was very much a tourism economy. But the more we delve into it, we realise that perhaps maybe we've underrated the strength and diversity of the economy there. It also has a major component of resources sector with a major export port at Bowen. It's also a major agricultural area. And there's some infrastructure spending happening in that area, including the establishment of a major energy hub. So all of these things are adding to the the strength and diversity of that economy, which is the thing we're most interested in. So we're actually including the Whitsundays region in our new, soon to be published later this week, edition of Top 5 Regional Queensland Hotspots. It's interesting, isn't it, Arjun, that we, no matter what the topic we talk about in these webinars, the questions people want to ask are always about location. And today is no different. Daniel's asking, do you think there'll be growth in the Hervey Bay market? Is that one you've looked at, Arjun?
Yeah, look, I feel like I'm hitting a few blanks here. I haven't done a deep dive for this particular session on Hervey Bay in particular. But what I can say is that Hervey Bay did join a little bit of that slowdown over the last couple of years. Not massively though, just a little bit in terms of the upper price market had slowed down from my last analysis. It's been not too distant from Bundaberg in terms of some of its trend, where it had a big pickup in the recent years before it slowed down just a little bit on that upper quartile. So I feel like Hervey Bay's got two aspects of its market: that very affordable ring that has been moving a bit stronger, and then this upper premium ring that has slowed down a little. So it'll be interesting to watch that as interest rates also improve that upper ring sort of price point. But in terms of long-term prospects for Hervey Bay, many people forget the aging population across Australia is a real thing. It's a big thing. And many lifestyle retirees, many of the older demographic, the movement there has been pretty unreal. And also the infrastructure in Hervey Bay and the job creation in that environment. It's really turning into what I'd say a major city with the way it's new facilities and things that are improving there when it comes to some of the infrastructure projects we've seen. But it did have a really, really good run. And what I would say is that really it's the lower quartile market that's been showing strength in recent times. But overall, the city has calmed down a bit when I last looked at it.
Yeah, I think that's very true. Hervey Bay is sometimes referred to as sea change for battlers. It is a coastal market with, it's wonderful for fishing. It's got Fraser Island, as it was previously known before the name change, just off the coast there. Wonderful, affordable lifestyle, and I think it's attracted a lot of lifestyle buyers for that reason. We've just got time for a couple more questions, and yes, they're mostly about location. Do you have any thoughts about Melton in the west of Melbourne, Arjun?
Yeah, so Melton is a very interesting one. So there is some growth happening in Melton when it comes to some metrics. There's a lot of metrics strengthening quite quickly in there. That's definitely one of those more affordable rings of Melbourne that's seeing a lot of activity. And whilst, yes, some people call it a whole separate region, it's still commutable. It's still part of the greater Melbourne area. All I'd say is keep an eye out on some suburbs vacancy rates. I think I found out some interesting things happening in Melbourne of late, the last 2 months. We've seen a lot of the new supply in the area that was picked up by investors come in and just weaken some of the vacancy rates in a few local pockets of the West. And so that's seen vacancy rates in a few pockets of the West move at a postcode level from 0.9 up to like 2.2 in just over a few months. So I think if you're comfortable with seeing some of the just the rental instabilities for a few months in a few pockets or just over the rest of this year, and you can put that aside for some capital growth prospects, I think the capital growth prospects are still quite strong in that area and they will recover. But our forecast for the western regions of Melbourne was about 3.3 to 6% growth for the 12 months ahead. So I wouldn't expect a booming year, but I would say that you're getting in early in the macro cycle of Melbourne. But you have to be mindful of, whilst you got the upside of cheaper prices in Melbourne, you have to be mindful of that rental vacancy. It has crept up all over Western Melbourne in recent times, and it is taking your typical 1 month rental campaigns are starting to go up to 2 to 3 month rental campaigns. So you just got to be a bit careful in some parts of the West.
Okay. We're just coming up to the hour and time for us to wrap up. Maybe we'll just end with one more question. Sorry, we didn't get to all your questions, but please feel free to follow up with either Arjun or myself if you would like an answer to those questions. Let's end with Joy's question about what Arjun you see happening with interest rates in the near future. We've had one reduction, and it sounds like it's not going to be another one anytime soon. What do you see coming?
And look, whilst I do okay on the housing forecast, I can't say my track record's perfect on the interest rate stuff. I think that stuff is always all over the place when it comes to what people think versus what actually happens. But what I will say is that right now, over the next year or two, it's definitely headed down based on what we can see so far. When you look at how much it's got to go down, an analysis we did was we looked at what point do the majority of the markets in Australia reach a fair value position? And that was about 4.5% typical interest rates for investors. And so I think if you're looking at 6.5 rates right now, coming down to 6.25 rates for investors, and banks offering fixed rates in high fives. So there is some forecast to head towards the fives, but I'd say that over the next 2 years, if the trends persist the way they are, you'd kind of come back to that sort of 4.5 mark, which is where, when I say not RBA rates, I'm talking about investor interest rates. Your rates should be kind of tracking around that 4.5 to 5 if you want to see 2/3 of Australia sitting at fair value. So I think that's kind of just using our methodology. It doesn't mean that that's the trends displayed in the economy. That could change any day, any minute. But the main thing is interest rates heading towards the down and more based on our analysis.
Okay. Arjun, just before we finish up, you have a message, I think, for everybody out there watching and listening today, to take away with them and consider.
Absolutely. I just suggest to everyone, if you'd like to have a chat with my team, visit investorkit.com.au. We're Australia's Buyers Agency of the Year for 2023 and 2024. And that's never been done before in terms of the back-to-back, and we'd love to help you out with growing your portfolio. Now, it starts off with a free 15-minute discovery call, and then should it all make sense from there, a more detailed Google Meets call over 30 to 45 minutes to dive deep into some of your goals and see how we can help. So that's investorkit.com.au.
And I would urge everybody to take advantage of that opportunity for a free discovery call. InvestorKit are winning multiple awards for a reason. That's because they're really good at what they do. And Arjun, I always love having this discussion with you. I think you're one of the, well, maybe the sharpest mind when it comes to analysing real estate trends and markets in Australia. Always love having conversations with you in these webinars. Let's do it again soon. I hope everybody watching and listening today got as much out of it as I did.
Thank you so much, Terry, and thank you everyone for attending. Catch you later. Bye-bye.
Okay, bye.